I want you to picture something for a second. It's 3 years from now. You open your bank account. The number on the screen looks almost the same, maybe a little higher. You feel okay about it. Then you go to the grocery store. A bag of groceries costs you $200. You try to fill up your car. Gas is $8 a gallon. You look at rent, at insurance, at a plane ticket home for the holidays, and every single number has doubled. Hook. Your $100,000 is still there, technically, but it can't buy half of what it used to. Nobody warned you. Nobody rang an alarm bell. There was no crash on the news, no red arrows, no panic, just a slow, quiet, invisible draining of everything you worked for. That is the scenario we're walking into right now. And the scariest part? Most people won't even realize it's happening until it's already happened to them. I'm going to be straight with you. The reason I made this video is because I don't want you to be one of those people. There's a man who has spent the last 50 years studying exactly this scenario. His name is Ray Dalio. He manages $160 billion. He called the 2008 crash while the rest of Wall Street was sipping champagne. And he's built his entire career on one skill, spotting big, slow historical patterns before they hit. Right now, Dalio is pointing at a pattern he calls the big debt cycle. It's an 8-stage pattern that shows up at the end of every major empire. The Dutch, the British, the Spanish, the Romans even. And according to him, we're in stage 7, right now, today. Stage 8 is the reset, the handover, the moment wealth violently transfers from people who weren't paying attention to people who were. In the next 20 minutes, I'm going to show you 5 specific moves to make with your $100,000 this week, so that when stage 8 arrives, you're the one catching the wealth, not the one losing it. Let's get into it. First, let me explain why this video is specifically about $100,000. Because $100,000 is a threshold. It's the line between I have some savings and I have real capital. Below $100,000, you're still in survival mode. You're building. At $100,000, for the first time, your money can actually start working for you. It can buy you assets. It can generate income. It can compound. But here's the dangerous part that nobody tells you. $100,000 is also the exact amount that gets destroyed the fastest in a debt crisis. It's too big to ignore, too small to have a private banker managing it, and almost everyone holding this amount has it in the worst possible places. A checking account, a savings account, a couple of index funds, maybe a 401k full of bonds. Those are the exact positions that historically get wiped out in the stage we're entering. So if you have $100,000 right now, or something close to it, you're standing at a fork in the road. One path leads to real wealth. The other path leads to watching your life savings quietly dissolve over the next 3 years. The difference between those two paths is what I'm about to walk you through. Before we go further, if you're getting value from this, take 2 seconds and hit the subscribe button. Everything I cover on this channel is about helping regular people read the patterns that the wealthy have been reading for centuries. Subscribe now, and let's keep going. Before the 5 moves, I need you to understand something. Because once you see these numbers, you'll stop thinking I'm being dramatic. The United States government currently owes around $36 trillion. Just the federal government, not counting state debt, not counting corporate debt, not counting household debt. The total debt pile across everything is over $90 trillion. And here's the stat that should honestly shake you. The interest payments alone, just the interest, now cost more than $1 trillion every single year. That means the US government is spending more money just paying interest than it spends on its entire military. Read that one more time. More money on interest than on defense for the first time in American history. This cannot continue. Mathematically, it cannot continue. And when a government reaches this point, history says there are only 3 exits. Exit 1, default on the debt. Politically impossible. No elected leader will do it. Exit 2, restructure the debt. Slow, painful, and takes 20 years. Exit 3, print more money and let inflation quietly dissolve the debt. Every single time, in every single empire, governments have picked exit 3. Because voters don't understand it. Because the damage is invisible. Because by the time people figure it out, the politicians who caused it are long retired. So here's your choice. You can either let this happen to you, or you can position yourself so it happens for you. Let's start with move 1. The first move is the hardest for most people, because it goes against every single instinct you have. You have to stop treating cash as safe. I know how that sounds. Cash feels safe. You open the app, you see the number, and that number doesn't move. No volatility, no stress, just stability. But here's the part nobody says out loud. Cash isn't stable. The number is stable. The value is bleeding out every single day. Let me paint this for you. Imagine your grandfather back in 1970. He had $100,000 sitting in the bank. He was proud. He was responsible. That $100,000 could have bought him a beautiful house in nearly any city in America. 10 years later, in 1980, that same $100,000 could barely buy half that house. He didn't spend it. He didn't lose it gambling. He simply held cash during a decade where inflation averaged 7 to 9% a year. The result? $45,000 gone. Silently. While he was sleeping. Or while he thought he was being smart. Now let's do your math. If you're holding $100,000 in a high-yield savings account earning you 4% interest, and inflation is running at 5%, you're losing 1% of real value every year. If inflation goes to 7%, you're losing 3% a year. That's $3,000 of purchasing power, gone annually, no matter what the number on your screen says. Over 10 years, at those rates, you've effectively lost $25,000 to $30,000. You'll never see it leave. There will be no transaction, no alert, no warning. It just evaporates. Dalio has a phrase for this. He calls cash trash in an inflationary environment because it's the one asset that guarantees you'll lose purchasing power while making you feel like you're being responsible. So here's what you do this week. Open your banking app right now. Yes, right now. Add up everything you have in checking, savings, CDs, and money market accounts. If it's more than $20,000 of your $100,000, you have work to do. Keep about $15,000 in cash, but don't think of it as safety money. Think of it as ammunition, dry powder. When stage 8 hits and assets go on fire sale, that $15,000 is what lets you buy while everyone else is panicking. Everything above that number. Get it into the other positions I'm about to walk you through. Today, not next month, not after you do more research. Today. Move 2. And this one is less about me convincing you and more about me showing you what the biggest players in the world are already doing. Start buying gold and hard assets. Now, before you roll your eyes, this isn't about hiding coins in your walls. This isn't about preparing for the end of the world. This is about recognizing a pattern that has played out in every major currency collapse for the last 500 years. And here's the evidence. The Dutch Empire, 1600s. Government debases the guilder. Paper money loses value. Gold holders preserved their wealth. Paper holders wiped out. Britain, 1931. The pound abandons the gold standard. Currency drops 40%. Gold holders protected. Cash holders lost a huge chunk. America, 1971. Nixon takes the dollar off gold. Gold goes from $35 an ounce to $850 an ounce by 1980. A 24-fold increase in one decade. The pattern is the same every time. Too much debt, government prints, paper currency weakens, hard assets hold their value or explode upward. And here's what should really get your attention. Central banks across the world, the same institutions issuing the paper currencies, are currently buying gold at a pace we haven't seen in 50 years. China, Russia, India, Turkey, even countries you wouldn't expect. When the people running the game start quietly moving chips off the table, regular players should pay attention. And let me show you what this would have looked like in your portfolio. If you had put $8,000 into gold at the start of 2008, by 2012, that $8,000 was worth over $16,000. Meanwhile, the S&P 500 was still recovering from a 50% crash. Gold doesn't always move. It can sit still for years. But when it moves during the exact moments when everything else is falling apart. That's why it belongs in your portfolio, not as a bet, as insurance. Here's what to do this week. If you don't have a brokerage account, open one. Fidelity, Schwab, Vanguard, they all work. It takes 15 minutes. Once you're in, buy GLD or IAU. Both are gold ETFs. Both track the gold price. IAU has slightly lower fees. If you want the physical version, go to AppMex or JM Bullion online. Buy American Gold Eagle coins, keep them somewhere safe. Target $8,000 to $12,000 in gold. That's 8 to 12% of your portfolio. Then, if you want broader protection, put another $3,000 to $5,000 into a commodity fund like PDBC. That gives you exposure to oil, metals, and agriculture, which all tend to rise when paper money falls. Now your hard asset foundation is solid. Move 3. And this is the one that separates smart investors from lazy ones. You need to stop owning stocks and start owning businesses with pricing power. Here's what I mean. When inflation hits, not every company survives it the same way. Some companies get crushed because their costs go up, but they can't pass those costs to customers. Other companies thrive because they can raise their prices without losing a single customer. That second group, those are the ones you want to own. Let me show you what this looked like in the real world. Back in the 1970s, the S&P 500 basically went nowhere for a decade. Adjusted for inflation, the broad market lost more than half of its real value. Let that sink in. If you were the classic just buy the index investor from 1970 to 1980, you spent 10 years technically making money on paper, while quietly becoming 50% poorer. But certain companies made their investors rich during that exact same decade. Oil companies, gold miners, food producers, household names that sold products people couldn't stop buying. These companies raised their prices every single year, and customers kept paying. Because what were they going to do? Stop eating, stop driving, stop brushing their teeth. So here's the question you need to ask about every single stock in your portfolio right now. If this company raised its prices 10% tomorrow, would customers still buy? If yes, hold it. If no, sell it. That's it. That's the whole test. Energy companies pass this test. Consumer staples, the companies that make toothpaste, soap, snacks, detergent, pass this test. Healthcare essentials pass this test. Utilities pass this test. Meanwhile, a lot of tech companies, a lot of discretionary consumer brands, a lot of growth stocks fail this test miserably. Because when people tighten their belts, those are the first things to get cut. Here's what to do this week. Go through your current investments. Ask the 10% price hike question about each one. Be honest. If a position fails, either sell it or significantly reduce it. Then rotate into pricing power sectors. The cleanest way to do this is through ETFs. XLE, energy sector. XLP, consumer staples. XLV, healthcare. XLU, utilities. Simple, cheap, diversified, no stock picking required. Target $30,000 to $35,000 of your $100,000 in these categories. This is your growth engine, not flashy, not exciting, but built to survive what's coming. Move for. And this one might be the most important because it directly contradicts the advice you've probably been given your entire life. Cut your long-term bonds immediately. Look, I get it. For 40 years, from 1980 to 2020, bonds were the safest, most boring, most reliable asset on earth. Interest rates kept dropping. Bond prices kept rising. Every financial advisor said the same thing. 60% stocks, 40% bonds. Set it and forget it. That advice is now actively dangerous. Here's why. When you hold a long-term bond, say a 10-year treasury paying 4%, you're locking in that 4% for a decade. If inflation runs at 6%, you're losing 2% of purchasing power every year, every single year. But it gets worse. If interest rates keep rising, which they have to when governments print money, then the market value of your bond actually drops. So you're losing money on two fronts at the same time. Inflation eats the purchasing power. Rate increases eat the market value. This isn't theoretical. In 2022, long-term bond funds like TLT dropped over 30%. People who thought they were in the safe part of their portfolio got absolutely slaughtered. Even Dalio has publicly said this. The old 40% in long bonds rule was designed for a deflationary world. We are no longer in that world. Period. Here's what to do this week. Open your portfolio. Find any long-term bond position. Anything with a maturity longer than 10 years. Look at bond funds like TLT. Look at target date retirement funds. They often quietly load up on long bonds without telling you clearly. If more than 10% of your $100,000 is in long duration bonds, take action. Replace them with 3 better options. TIPS, Treasury Inflation Protected Securities. They automatically adjust with inflation. Short-term Treasury funds, the ones with maturities under 3 years, far less risk. I bonds, purchased directly from the government at treasurydirect.gov. Inflation protected, backed by the Treasury. Boring, safe, works. Your total fixed income target should be between $10,000 and $15,000. No more. The old rules are dead. Stop letting them kill your portfolio. Move 5, the one most people ignore, which is exactly why it matters. Get international exposure deliberately. Here's the hard truth. If you're American or your savings are in dollars, you are making a huge unspoken bet. You're betting that the United States will remain the dominant economic power forever. You're betting that the dollar will remain the world's reserve currency forever. History is not kind to that bet. Go back to 1900. Britain was the global superpower. The pound was the dominant reserve currency. British bonds were the safest asset on earth. If you were a wealthy British person in 1900, you kept everything at home. Why would you bother with anything else? By 1950, 2 world wars later, the pound had lost over 70% of its purchasing power against the dollar. British investors who stayed home watched their wealth slowly get buried. Meanwhile, the smart ones, the ones who had diversified internationally, came out of the 20th century richer than ever. The signals of the same shift are happening right now. Central banks have been reducing their dollar reserves for 6 years straight. China, Saudi Arabia, Brazil, and others are setting up trading systems that completely bypass the dollar. Global gold buying is at 50-year highs specifically because institutions are moving out of dollar-based assets. Does this mean the dollar collapses tomorrow? No, it doesn't work like that. It's slow. It's grinding. It takes years. But the trajectory is clear. Here's what to do this week. Go into your brokerage and buy Vexus. That's Vanguard's total international stock fund. One purchase gives you exposure to 7,000 companies across dozens of countries. Or buy VWO, which focuses on emerging markets, the countries growing faster than the developed world. If you want to be more targeted, look at INDEV or India exposure. Dalio has been very public about India as the most promising major economy in the world right now. A 1.4 billion person consumer base, growth rates double what the US sees, structural advantages that are hard to overstate. Target $15,000 to $20,000 in international exposure. That's 15 to 20% of your portfolio. This isn't about abandoning America. It's about refusing to make a single country bet with your entire life savings. That's not investing, that's gambling. So let's put the whole thing together. $15,000 in cash, your ammunition for the crisis, $10,000 in gold, your insurance policy, $5,000 in commodities, your broad hard asset coverage, $35,000 in pricing power stocks, your growth engine, $15,000 in short duration and inflation protected bonds, your true defensive position, $20,000 in international and emerging market exposure, your geographic hedge. That's your $100,000, redesigned for the next 3 years, not the last 40. Now here's the beautiful part. This portfolio doesn't need a specific scenario to work. If we get heavy inflation, gold and commodities rise, pricing power stocks raise revenues, international exposure hedges the dollar, you're fine. If we get a crash, gold often rallies, short bonds hold. That $15,000 in cash becomes your weapon to buy assets at bargain prices. You come out ahead. If we get a boring sideways decade, your pricing power stocks still pay dividends. Your international exposure captures growth where it's happening. Your gold compounds slowly. No single scenario breaks this. That is the whole point. Here's something I want you to really sit with before you click away. Every major wealth transfer in history has the same story. A small group of people see the pattern early, they position themselves quietly, and when the storm hits, they don't just survive it, they become rich because of it. The people who came out of 2008 wealthier than they went in weren't geniuses, they weren't fortune tellers. They just had cash and courage when everyone else was panicking. They bought foreclosed houses for pennies. They bought blue chip stocks at prices nobody had seen in 2 decades. 5 years later, they had doubled, tripled, sometimes quadrupled their net worth. Their neighbors were still recovering. The same thing happened after the 1970s. The same thing happened after the Great Depression. The same thing happened after every debt cycle for the last 500 years. The pattern doesn't care about your politics. It doesn't care about your feelings. It doesn't care whether you think this video is hype or not. It just happens, over and over and over again. You have $100,000. That is real capital. That is real freedom. That is a real chance. The question is, are you going to spend the next 12 months quietly losing it to inflation while telling yourself you're being safe? Or are you going to actually do the 5 things I just walked you through? Stage 7 is here. Stage 8 is coming. The window to prepare is open right now, but every historical pattern says the same thing. These windows never stay open long. The people who act in stage 7 build wealth. The people who wait for stage 8 to become obvious, they become the wealth that gets transferred. You decide which one you want to be. If this video hit different for you, do me one favor. Hit that like button. It genuinely helps more people find this information, and right now, a lot of people need it. Then drop a comment below. Tell me which of the 5 moves you're making first. Don't just scroll past, actually write it. Because the moment you write it publicly, your chances of actually doing it jump dramatically. I've watched this play out in our community over and over, and if you're not subscribed, subscribe now and turn on notifications. Because the next video in this series is going to be even more important. I'm going to walk you through exactly what to buy, when to buy it, and how to act once stage 8 actually begins. You do not want to find out about those opportunities after they're gone. $100,000, 5 moves, 1 closing window. Your move. I'll see you in the next one.